Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures pushing higher today as President Donald Trump's coming wave of tariffs is poised to be more targeted than the sweeping tariffs previously threatened, as first reported by Bloomberg News. Trump will announce widespread reciprocal tariffs on nations or blocs come April 2nd, but is set to exclude some from the levies. Also, the administration not planning separate sectoral-specific tariffs to be unveiled at that same event, as Trump had previously said.
Plus, we'll get the latest read on the Fed's preferred inflation gauge this week after the central bank. They held rates steady at its latest meeting, and Chair Jay Powell downplayed some of those growth fears. Economists are expecting February's core PCE inflation data to come in high, despite the downside surprises in the month's CPI and PPI prints. Additionally, the February personal income and spending report will offer fresh insights into consumer consumption.
And earnings season continuing. Numbers out today from the world's biggest EV maker, BYD, showing sales last year surpassing the $100 billion mark, leapfrogging Tesla on revenue, as the Chinese auto giant wowing consumers with a range of electric cars and hybrid cars packed with high-tech features. Investors will get an additional read on the state of the consumer and the health of corporate America, with results coming in from KB Home, Lululemon, and GameStop this week.
U.S. stock futures pushing higher today on reports that the Trump administration's coming wave of tariffs will be more targeted than the barrage that the president has occasionally threatened. According to reporting from Bloomberg and the Wall Street Journal, it's a sign of relief for markets gripped by this anxiety, crippled in some cases, and you can merge the two words together if you'd like to, like I did. But ultimately, that anxiety has knocked around Wall Street because of the threat of an all-out tariff war. Joining us now to discuss how this will all play out, we've got Peter Harrell, who is a non-resident fellow at the Carnegie Endowment for the International Peace. He previously served as Senior Director for International Economics and Competitiveness in the National Security Council during the Biden administration. Great to have you here with us this morning. So, this is what we had been discussing, and the mindset around the Trump administration potentially being more targeted than just wide-ranging and sweeping tariffs. How should we be thinking about this now going forward, and for what CEOs have been trying to do and making sure that they're clear of some of the tariffs that are coming forward?
Well, thanks for having me on this morning. I keep two things in mind when I think about the Trump administration and tariffs. First being, as we've seen over the last 2 months, nothing's final till the president says it's final. So we're clearly seeing a shift in tone out of administration officials speaking to the press, out of administration officials you talk to privately. But I do think we have to keep in mind nothing's going to be final until April 2nd, when the president actually rolls it out. With that big caveat, we do see some evidence that at least the cabinet, at least the senior members of the administration around the president, are now planning for a somewhat narrower set of tariffs on April 2nd than we had been hearing about a couple of weeks ago. Though it's important to understand that this is still a quite broad set of tariffs, just not as kind of spectacularly broad as it could have been a couple of weeks ago. I think we see two big changes, again, in terms of the messaging coming out of the administration. So the first thing is they're talking about imposing these quote unquote reciprocal tariffs only on a subset of America's trading partners. Now, these are going to be America's biggest trading partners. They're talking about doing it on, countries like Vietnam, on some of the European countries that are our biggest trading partners. So while it will be a subset of our trading partners, it will be a large share of trade. The other thing, two important things they're talking about, is it looks like the potential rate might be a little bit lower than the sort of 25-30% some of us had been thinking a couple of weeks ago. So we might be seeing a somewhat lower rate. And then they're making clear that they will not, at least for now, probably be stacking sectoral tariffs on top of these reciprocal tariffs. And just to briefly give a sense of what that means, if you have stacked tariffs and you have a 25% metal tariff, and a 20% reciprocal tariff. That's actually a 45% tariff. And they're now talking about putting that on hold, but still expecting some big announcements on April 2.
Who is behind these headlines that we're getting on tariff changes from the White House, Peter? And I ask because I think it's important for investors to know whether President Trump actually does care what the market's doing and therefore is walking back his tariff policies behind closed doors, or if this is just the economic side of the White House trying to appease the market and this is kind of much ado about nothing.
I think this is the big question. I mean, just in the last couple of days, we've definitely seen National Economic Council Director Hassett. We've seen Treasury Secretary Bessent all talk about the narrower scope. We've also seen some information that I think has been attributed to Secretary Lutnick over at Commerce, who, of course, has been a major hawk within the administration. So we're definitely seeing this out of multiple points in the cabinet. That said, I think you are making exactly the right point. We don't know that this is going to be narrower until we actually see what the president says. And I use the Canada and Mexico tariffs as an example where some of the economic side of the House had not wanted 25% tariffs on Canada and Mexico. Trump brought them into force. There was a bad market reaction. They then pulled back. So I think the market is resonating, but whether it has really gotten through to the president himself, I think remains a bit TBD.
How much do you think globalization is baked into so many companies' valuations and growth as it specifically relates as well to the U.S. growth in itself? As we think about how these companies contribute to GDP, that's a larger consideration if we're now cutting off some of those larger globalization efforts of the past.
Yeah, so clearly, the president campaigned on an anti-globalization agenda and on, as he puts it, an America First agenda. So it's not surprising to see this playing out. That said, I do think, as you say, when we look at these sweeping tariffs, there are ways in which these sweeping tariffs actually undermine efforts to rebuild American manufacturing. If you have 15, 20% tariffs on auto parts that then are going into autos that are being assembled in the United States, that's actually increasing the cost of building autos here in the U.S. Another example that I think the administration is going to have to grapple with, the tools to make computer chips, semiconductor manufacturing tools, a lot of them are made in Europe and in Japan. And they cost like $100 million a piece. And so if you put a 25% tariff on that, you're actually going to increase the cost of making computer chips here in the United States. So I think they really need to grapple with, is this really broad approach to tariffs the right way to accomplish their objective of rebuilding manufacturing, or should we have something a bit more targeted? One final point, because you talked about earnings. Look, I think big U.S. corporates have a low tariff environment heavily baked into their earnings, earnings estimates. One estimate I saw a couple of weeks ago, before we've gotten these narrower reports, but the initial kind of reports of 25% reciprocal tariffs on pretty much everyone could have been a 16% hit to S&P 500 earnings this year, because that would be the cost of actually paying the tariff. So I think there are some real potential earnings implications here for companies that are dependent on imports.
Peter, great to see you this morning. Thanks so much for taking the time with us.
Thank you.
Let's turn to the market impact of tariffs. Stocks rallying as investors breathe a sigh of relief on the trade front. But is the worst of the market selling behind us? That's a big question. Joining us now to discuss, we've got Matt Orton, Raymond James Investment Management Chief Market Strategist here. Matt, let's just begin there. Is the worst of the selling behind us now?
Hey, good morning, Brad. Always great to join it. I think that's unknown at this point. I think this relief that we're seeing is more a result of the fact that there was no sort of whiplash from the White House last week. And it seems like we've had more marginally positive news with respect to what tariffs might potentially look like on April 2nd. But I don't know if there's too much that we can put into that until we actually have certainty. Until we're actually past April 2nd, it's very difficult to say that that we're actually going to have a narrower scope of tariffs, that we're not going to stack tariffs. So when I talk to clients, I think my main message is wait until we actually know what's going to happen and continue to use the playbook of better diversification, because there's a lot of parts of this market that have been working, like dividend growth, geographic diversification into places like Europe. Those are still areas that work, and balancing that with fixed income that has also done very well this year. I think that continues to be the playbook. And hopefully after the first week of April, as we get into earnings season, that'll be the time to really start finding what's been thrown out with the bathwater and being opportunistic with respect to downside.
How shaky does that make today's rally, Matt, just given the opportunities that you just expressed that are there in the market in some of those dividend plays, those safer areas? If we get to a certain level of gains in the market, will we just see selling so that folks can get more defensive?
Yeah, Madison, I think investors are going to slow roll this. While today's enthusiastic, I think it's just a sigh of relief maybe that we were heading into this weekend with a little bit more concerns about what might be down the road. But I think a lot of these more stable parts of the market, sectors that have done really well this year, like energy, healthcare, the bucket of dividend growers, you tend not to see these massive rises with respect to the cycle of optimism versus pessimism. So that's one reason why I continue to like that pocket of the market. I might actually fade or really trying to avoid leaning into the rally that you might see in information technology or consumer discretionary or communication services, because those names are going to be whipsawed around by every single headline with respect to not only tariffs, but PCE on Friday, which also could be another surprise for the market as well. So I would hold back on making any big moves until we actually get past the first week of April and really into earnings season. And that's when I might be looking to buy some of the mega cap names that have been thrown out with the bathwater, some of the big banks that have pulled back to levels that we had prior to the elections. Those look like compelling long-term opportunities to me.
Outside of just relief, what is the next kind of conviction trade that you see brewing beyond just us saying, okay, the worst of the selling is behind us? It doesn't seem like there's a catalyst for this market right now.
So, Brett, I think the catalyst is going to be earnings season, because tariffs are not, I think the biggest uncertainty that investors face right now is what earnings growth is going to look like later this year and into 2026. So we've already seen valuations pull back on a number of names that have led the rally before. So I think that could provide a ballast if you actually start to get good earnings in some of those mega cap names, and you confirm that growth is still there with respect to some of those secular growth trends and artificial intelligence and the build out that's happening there. But sectors like healthcare are expected to have an inflection with respect to their earnings growth. So if that materializes, that'll provide some more tailwinds to a sector that also embodies some growth, but has defensive characteristics too. So I think earnings season is going to bring the focus onto who the winners can be in this environment going forward, because not everyone's going to be able to win. Right now is the time you want to be selective and you want to focus on who your actual consumers are. But there's a lot of opportunities out there.
It just sounds more, Matt, like relief is the theme of the front half of this year then. And because if it's relief that the trade war is not as pronounced as it could be, and then relief, especially on the earnings front, when we've already had companies like they tend to do, cyclically at the beginning of the year, downplay some of the expectations and then try to beat on those sandbagged expectations. It sounds like it's just more relief that investors are banking on right now.
I wouldn't describe it so much as relief, Brad, as I would really call it reality. We're getting a reality check in the first quarter of this year of what tariffs and really what Trump campaigned on is actually being implemented. That's why we have so much volatility. But that reality is also what's driving the increase in breadth in the market, because earnings are actually improving for the S&P 493. That's a real durable trend that investors can lean into. And again, that's why earnings season, I think, is going to be really important to confirm the reality that financials, healthcare, energy companies, a lot of more cyclical parts of this economy can still work going forward. And that's where I would be looking to pick up opportunities that have fallen over the past quarter or so.
Really great insight and advice for our listeners. Matt, thank you so much for joining us. Appreciate it.
Thank you.
Coming up on the morning brief, we're going to count you down to the opening bell on Wall Street. Plus, DNA testing company 23andMe filing for bankruptcy. Bringing the why behind that move next. Tesla shares also pushing higher. The stock attempting to hold off on a 10th week of losses. Will those gains hold through the week? We'll discuss that and much more on Morning Brief.
It's now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, 23andMe filing for Chapter 11 bankruptcy protection to help the genetic testing company sell itself. The company also announcing its CEO's resignation after multiple failed takeover bids. 23andMe plans to continue operating through the sale process here. Shares of 23andMe are down 45% pre-market on this news.
Yeah, I mean, this is a company that has been through a lot over the past couple of years, several challenging instances. Among the few that I can mention here is the data breach that occurred where hackers got access to a lot of personal data that led to a lot of questions from consumers about whether the company was protecting their data. That led to a lack of revenue reported for the company. So we obviously saw a sell-off in those shares after that. Then the company was at risk of being delisted due to the sell-off in stock. Finally, we had the CEO, Ann Wojcicki, looking for a takeover bid after the independent board members all collectively resigned. And now finally today we have Ann also announcing that she is stepping down as the company does file for Chapter 11 bankruptcy here. This has honestly been a long time coming for this stock. They've weathered a lot of challenges and competition in the space, among a lot of personal challenges for the family, which we were talking about as well. And, you know, seeing this take private proposal not working out for them, not entirely surprising given how long she had been trying to find a take private proposal and had not been able to do so.
Yeah, one of the comments that we do have from the company here this morning, Mark Jensen, who's the chair and member of the special committee of the board of advisors, says after a thorough evaluation of strategic alternatives, they ultimately determined that a court-supervised sale process would be the best pathway forward to maximize the value of the business here. They expect this process ultimately to advance some of those efforts to address the operational plus the financial challenges that they're facing, that in part of the quote, and we'll see exactly how this process plays out from this juncture.
Certainly. At a minimum, you can see those company shares plummeting today. Next up, Alibaba-backed Ant Group is reportedly using Chinese and U.S.-made semiconductors to build more efficient AI models. The combination is said to help reduce the time and cost of training AI models and limit reliance on a single supplier like NVIDIA. You can see Baba shares up about 0.9% here. Really interesting news from Ant Group developing these techniques for training AI, cutting costs by as much as 20%. And this is one of the key questions for the AI space that led to such a sell-off in some of these big chip giants like NVIDIA after the announcement of DeepSeek being able to train AI for less money. What does that mean for the likes of NVIDIA? Some analysts have told us on this very show that it's good news for them because it means the little guys can afford to have their own AI models now if you can train them for cheaper. But you want to be able to charge as much as possible and have those big name clients coming in as well. So does it paint a picture of China having the ability to offer a cheaper path to AI? And that's, I think, the big question for markets.
Yeah, as much as I would love my commentary to be yes, Quen or yes, Queen, which is Alibaba's cloud kind of AI play, Quen, I believe was the name of it. At the end of the day, it's kind of hard to see where there's going to be a major advancement of kind of like the same way that we all think about Alexa as, and I'm sorry if I'm setting off anybody's Alexa at home, the same way that you would think about that as the verbification of your experience with a home assistant. What is going to be that major AI chat bot and generative AI kind of application that a lot of consumers can point to and say, okay, this is enhancing my life in such a major way that it's become a part of the everyday use that I have. And for Alibaba and for Ant, and especially given the investments that they have and the deal making that's taken place in the past, that's what makes it all the more important, because Alibaba, for their cloud play, essentially think of them as the same as like an AWS, just of the Eastern Hemisphere. And now we're thinking about on top of that on top of that cloud for Alibaba and what they're thinking about with generative AI, how many different partners they're going to be able to sell that experience into, and is Ant Financial going to leverage that same cloud? And so this has a big deal for Alibaba, but it also is huge for Ant potentially, and just what that could bring for a lot of the financial services space for their customers at the end of the day.
Totally. And to your point, the company Ant did talk about how they were able to leverage models for industrial AI solutions, including healthcare and finance. So they are making it more of that company-based play versus consumer-based play. And lastly, I'll just mention, given the challenge over export controls and the impact that's going to have on chips, they do talk about how they were mostly training and relying mostly on AMD and also Chinese chips for their latest model. So that's according to Bloomberg reporting, and interesting to see that on the back of any concerns about those export controls as well.
Yes, Quinn, yes.
Love.
There we go. All right.
He got it in.
I had to. All right, next up, DoorDash, Williams-Sonoma, Expand Energy, and TKO Group, all joining the S&P 500 today. It's part of a quarterly reshuffling of the index. The changes take effect before the start of trading today. There you're taking a look at some of those shares pre-market for DoorDash, Williams-Sonoma, Expand Energy, and TKO, all up. This is typical and a move that you would see as some of the companies get reshuffled and enter into the index, because it means that, hey, more people who own them in their retirement accounts or ETFs, whatever the case may be, they now own a piece of these companies too.
Yeah, it's interesting to see the names that they own and what that means for their growth moving forward here. And usually you do see a bump in those names when they are added. You're seeing that playing out today. But I will also mention the broader markets are up today. So it's a good day to be added to the S&P 500 because stocks are moving to the upside. So they are going to lift all ships with it. When you have ETFs buying the likes of the S&P 500, for example, that tends to lift all boats here. But interesting to see those individual names. Again, you got DoorDash, Williams-Sonoma, Expand Energy, and TKO as well.
You know, it's interesting. As we were talking about DoorDash last week, I think it was you and I breaking that down, or it might have been me and Ali. We discussed it at one point where the Klarna deal, that seemed to be the big talk of the weekend, the brunch table talk of the weekend. Everybody's just trying to figure out why you have to break down your DoorDash or your caviar payments with Klarna. A sad state of affairs, many were calling it. But it was interesting as well, because now if you go into some of your apps, for instance, if you go into Uber, you can see that you're getting like a small discount if you actually use one of those services too. So that starts to elucidate some of the incentivization that they're going to try and put forward to get people to pay in installments, get 50% off if you're using that service. I thought it was just fascinating to see it play out, and for that to be the brunch conversation.
Well, and we'll just remind folks that Klarna and DoorDash partnering so that you can do a buy now, pay later type system for your food delivery services. Of course, there are questions about what the fees look like if you don't stick to your payment schedule, and that is, of course, a risk amid an environment where consumers are already struggling. All things we'll keep covering here at Yahoo Finance. Finally, Bayer falling today after the company was ordered to pay $2.1 billion in a case against its Roundup weed killer. The Georgia State Court siding with the plaintiff, who says the company's Roundup weed killer caused his cancer. The verdict includes $65 million in compensatory and $2 billion in punitive damages.
This was just the latest legal setback for the company that has been fighting lawsuits stemming from its $63 billion acquisition of Monsanto, which developed Roundup. The series of court battles have already cost the company about $10 billion, and Bayer says it will appeal the verdict in efforts to overturn the decision.
We're going to have all your markets action ahead as stocks continue to move into the green. Stay tuned. You're watching Morning Brief.
All right, there you're taking a look at the opening bell at the New York Stock Exchange and at the NASDAQ. At the NASDAQ, you've got Ionis ringing the opening bell, ticker symbol IONS. And at the New York Stock Exchange, you've got Liberty ringing the opening bell. Different Liberty than the jingle that you're probably singing in your head right now, Liberty Bibbity. All right, taking a look at some funfetti on the right side of your screen. And at the New York Stock Exchange, you've got a good shot of the floor on Wall Street. All right, taking a look at the Dow Jones Industrial Average as we begin today's trading activity. We are seeing exactly what we saw in the futures now flow into the start of today's trading session. The Dow is up fractionally 0.8%. The S&P 500, you're seeing that up 1% to kick off today's trading activity. And the Nasdaq Composite, that too is in the positive gains party right now. Let's break down a little sector action from what we're seeing at this juncture, and let's toggle on over to those sectors. There we go. 11 S&P 500 sectors. We've got them loaded up here for you on the screen. We're green across the board right now, being led by technology. Let's take a look, deeper dive into the technology space here. As we're looking at the NASDAQ 100, you've got all of your Mag 7s essentially in the green right now. Tesla trying to mount a little bit of a bounce here. Let's put this on a 5-day view. Actually, you know what? Year-to-date's probably better. Taking a look at the year-to-date, still down 36%, but this is what we're focused in on, as last week, Elon Musk asked his employees not to sell the stock. But ultimately, as of right now, you're seeing some pressure on shares on the year-to-date scale. Here today, though, it's a positive mover. It's up by about 4.25%. Meta platforms, Microsoft, NVIDIA, Apple, Amazon, Google, Alphabet, whatever you want to call it at home, call it up here on the day. And then let's also take a look at the Dow 30 components here as well. You've got a little bit of red peppered in, but mostly green here, led by some of those technology companies, where we've got the red coming into play. And the deepest decliner here on the day, you've got some of the healthcare plays that are moving lower. As of right now, Merck bringing up the boost. It's down by about 0.9%. United Health and J&J also seeing declines, fractionally as they may be. They are rounding out some of the laggards here for the Dow Jones Industrial Average. With that, I'll send it back on over to the desk. Maddie.
Thank you, Brad. It's time now for today's strategy session. Bond market investors have a new mantra: don't fight Besant. Since heading the Treasury, Scott Bessent has focused on lowering rates and keeping them down. Strategists responding in kind by cutting their targets for the 10-year yield. The 10-year rising today, currently trading just around the 4.3 level, down about 7% since President Trump's inauguration day. Joining us now, we've got Colin Martin. He is Schwab Center for Financial Research fixed income strategist. Colin, thank you so much for being here today. I love this new mantra. We always say don't fight the Fed. Now we're saying don't fight Besant. It kind of reminds me that we're in this moment where we're focusing a little bit more on the White House than the monetary policy from the Fed. What does that mean in terms of allocation for fixed income investors?
So even given the news from Besant and the administration, we're not really changing our outlook right now. We favor a benchmark average duration. To put that into common terms, it just means, average maturity of 5, 6, 7 years, something like that. That's basically what the average maturity or duration of the Bloomberg Aggregate Index is. When we talk about that, it's kind of like just saying go for the S&P 500 to get exposure everywhere. That's our outlook for our clients. We don't think investors should focus on maturities that are too long, because there's a lot of interest rate risk there in case interest rates rise. We don't think that they should be too short also, because we think that the Fed will probably continue to cut rates a little bit later this year and into next year, so there's some reinvestment risk there also. So benchmark average duration, take what the market's giving you, because we think the yields are still really attractive. You can get high quality yields of 4.5%, 5% or more, depending on the maturity or the type of bond, but we still think that's really attractive.
So for investors here this morning that are just trying to take a step back and make the case in their own minds of fixed income versus equities when you have a pullback like we've seen, what is the case there?
Well, it's always an and case, not an or case. That's what we talk about with our clients, and we get that question all the time, because we find that a lot of investors maybe are underallocated to bonds because it is complex. They don't understand them as well as they understand the stock market. So we get that question, but we always talk about bonds for the long run. And again, if we frame the market like we're seeing today, these yields are at levels that, aside from the past couple of years, we really haven't seen in 15 or 20 years. And when you look about adding bonds to a stock allocation, that limits the volatility and can give you more predictive returns. So we still think they're really attractive. If you want to be tactical, then you can focus on short-term investments. Money market fund yields are still objectively attractive. You can get yields of around 4% or more with, hopefully no price volatility, and that can give you, cash if you want to be tactical, but we still think intermediate term bonds with those high yields, we think it's a great place to be today.
And it sounds like you are not too worried about the headlines coming from the White House, coming from Treasury Secretary Bessent, that you are sticking to your original plan. Is that a message that investors should be following, who are monitoring every headline coming out of the White House and obviously moving their allocations based off of those headlines? Is it better to not pay attention to the politics right now?
I'd say so, but I think it's really hard to do that today. But that's usually our outlook with bonds. They're meant to be long-term investments. We don't want our clients reacting every day with the bond market. Should I get in or should I get out? It should be a long-term view. Coming into the year, though, we thought that yields could actually be biased a little bit higher because we saw a lot of those inflationary impacts. But what we're seeing is it looks like the growth concerns are front and center more. And I think it still remains to be seen. All we know is that there's a lot of uncertainty right now. We heard that from Powell last week. He highlighted that the outlook is really uncertain, and he kind of cautioned us to take their projections with a grain of salt because those can change really quickly as well. So with that uncertainty, that's kind of why we have our benchmark average duration. So we're not making this big call, be long or be short. Take what the market's giving you. And then if we get more clarity over the next few months or quarters, then maybe we'll have a more firm duration outlook.
And so you have the Fed's preferred inflation gauge coming out this week in PCE. And one of the major things at this juncture, too, is just how the Fed is going to be looking through data points like that to determine what their next decision might be. And then the fixed income market also trying to best get ahead and not fight the Fed, but anticipate what that timing may look like. What is the read through from the fixed income perspective now on all of these data points as the Fed is looking for a trend?
Yeah, every few months it's like we're looking at different things. For a while it was inflation only. Growth, labor market didn't matter because they were doing fine. Now it's much more balanced. The risks are balanced to both sides. Inflation's a little bit high, and given that the labor market has held up relatively well, we got a scare last year, but it's doing okay for now. So I think inflation is probably still their number one focus, but given all the uncertainty we're seeing, if we start to see the soft numbers, the headlines, the consumer confidence numbers translate into job losses or a significant slowdown in job growth, uptick in the unemployment rate, that's something that the Fed could pivot there to maybe protect to the downside. But right now I think it still is inflation because that's still too high, but we'll see how that evolves over the next few months when this soft data can translate into something that we can actually see in the hard data.
That's a great point.
Colin, thanks so much for joining us in studio today.
Thanks for having me.
Absolutely. Let's turn now back to the equities market here. Morgan Stanley strategist Mike Wilson says the tides may be turning for U.S. stocks. Citing a weaker dollar, the strategist says the earnings outlook for equities will improve and that the massive rotation out of stocks this year could turn around. There you're taking a look at a partial quote on the screen. Relative performance versus international developed equities can swing back in favor of the U.S. in Mike Wilson's view.
Yeah, it's interesting. This is really all based off of a call for a weaker dollar, which we may or may not be getting. It does seem like the Trump administration is in favor of that move thus far. Having said that, Mike Wilson again saying that a weaker dollar would offer a tailwind specifically for U.S. earnings and U.S. earnings revisions moving forward and would be a tailwind for driving more money back to the U.S. We've seen this kind of divulging of the U.S. exceptionalism narrative. And if Wilson's call holds true, this idea that a lower dollar will lead to a return to U.S. equities and a flight back to those large cap stocks in particular off the back of what we have seen is a little bit more euphoria around international equities thus far this year.
Yeah, and just to give people a barometer out there for Q1, and this is according to some FactSet data, for Q1 2025, the estimated year-over-year earnings growth rate for the S&P 500 is 7.1%. If that is the actual growth rate for the quarter, it's going to mark the 7th straight quarter of year-over-year earnings growth reported by the index. So that just kind of a measuring post to keep in mind as we go into this next earnings season.
Absolutely. It's such a great point, Brad. And I do think, to me, what also really stands out is that he's talking about the Mag 7 tech stocks potentially already bottoming. And this is not the first call that we've seen like this over the course of the weekend. Keith Lerner over at Truist, friend of the show, also talking about the same thing, that he does see this return to U.S. exceptionalism. It's fascinating to me that we had 16 years of U.S. stocks on top, and what did we have? 8 weeks, maybe max, of a question mark to that narrative. And now we've already got analysts running back to say, hey, get back to the U.S. where you belong.
Yeah, big question mark.
Big question mark, exactly.
Everyone, coming up, we're taking a look at the Chinese EV maker BYD's record-breaking quarter. That's on the other side of the short break. Now time for a trending ticker that we're watching this morning. You can scan the QR code to track the best and worst performing stocks as we are of the session with Yahoo Finance's trending tickers page. And that ticker is Tesla. Tesla shares are higher so far this morning. The automaker attempts to start the week in the green, and it comes after a difficult 2 months that saw Tesla shares drop for 9 consecutive weeks, its worst streak ever. Shares are higher here this morning by about 6%. Of course, a surprise town hall meeting that was taking place last week where Elon made a plea to and not just employees, but also shareholders of the company to not sell their stock. And so that certainly was rattling through the mindset of some of the investors out there on Friday and perhaps over the weekend a little bit more.
And it does appear, in looking at the flows, that some of this is retail investor activity. We do have significant volume on Tesla this morning as well. So this has a little bit of conviction behind it when you see this move to the upside of 6%. I mean, it continues to fascinate me covering this stock because it is a company that does not tend to move on fundamentals, because we're about to talk to you about a company that beat out Tesla, leapfrogging Tesla's revenue. That was BYD. You would think that that type of headline, which is based on numbers and facts and fundamental news, would be something that would put pressure on a company like Tesla. But you have CEO Elon Musk telling investors to get in, investors to keep their stock, and you're seeing that exact action playing out in the price action today when it comes to Tesla.
Yeah, one of the interesting things, and coming back to the financials and the fundamentals here, Ford and Tesla, for some data from FactSet here, they both actually lead the earnings decrease since since December 31st here. So that just kind of playing into what we've already seen transpire. Of course, the markets are forward looking, so it's more so not just what have you done for me lately, but what are you doing in the future as well. And I think that earnings narrative is really going to take center stage as we get into this next cycle and season.
And to your point, Brad, really quickly, we should mention that a couple of the auto names are also getting a bit of a relief rally this morning off the back of that news that tariffs may not be as widespread as we initially thought. You can see on your screen here. Thank you, guys. You've got Ford, General Motors, and Stellantis all moving to the upside. General Motors in particular has been hovering around 3% gains all morning. Well, shares of Chinese automaker BYD jumping this morning after notching record quarterly profit and sales, topping $100 billion in 2024. The world's largest EV maker topping Tesla's annual sales of 4.2 million vehicles. Here with more, we got Sean Tucker, Kelley Blue Book lead editor. Sean, great to speak with you. Talk to me about how you are seeing this dynamic playing out. When you take a look at those revenue numbers, you've got BYD around 107 billion and Tesla around 98 billion, so pretty big leapfrog there. Are you seeing that in terms of customer activity?
Globally, yes, absolutely. BYD has a price advantage in most of the globe. They have a cost advantage in that they're cheaper to build, and they've increasingly got a technology advantage. Last week, they showed off a charger that they claim will refill most of the battery in about 5 minutes. It's the kind of thing that's more a perception issue than anything else, because in reality, it would take years to deploy those to everywhere that they need to have them. But it convinces consumers that, hey, this is the best technology out there.
And so with that in mind, as you're thinking about what BYD needs to do to really capitalize more longer term on the mind share, because that is a larger shift that we've seen from purchasers too, mind share that some of the other automakers and EV makers have been able to acquire in addition to the market share from Tesla here. How does that kind of play out more long term from your own analysis and what we've typically seen in the past when you do see a newer company capitalize on a moment where there is that consumer sentiment shift?
They face a unique challenge in that both the United States and Europe are trying to slow them down in a sense. And so you're seeing the growth mostly outside of those markets. But the mind share, they are doing an outstanding job of growing as quickly as they can in growing markets outside of the West.
And talk to me more broadly about what you're seeing in terms of Tesla activity in particular. I know that you specialize specifically in kind of researching and looking into consumer-driven activity and advice over at Kelley Blue Book. Have you seen a real sea change that is what some investors have told me unrecoverable when it comes to consumer demand for Teslas?
Yes, I don't know if I would say unrecoverable, but what we've seen just recently is that the loyalty rates and the defection rates, which historically Tesla's been far better than the industry average, they've fallen to about the industry average right now. And that's kind of a lagging indicator in that I don't know that we're getting a reflection of the last week in that. So Tesla's essentially becoming an ordinary car company. And when you treat it as an ordinary car company, you look at it and you realize it's got an aging lineup. There's nothing really exciting coming down the pike anytime soon. They gave up a major competitive advantage last year in sharing their charging tech, and they made a big bet on automation. Musk says that's the future, but everyone else has also made a big bet on automation.
Right. So, Sean, what does Tesla have to do next to turn that around and not be an average car company anymore?
So, Musk tells us it's not a car company. And if that's the case, I don't know what to tell you because I'm an analyst of car companies. But as a car company, what Tesla primarily needs right now are two things. They need new, interesting products. What they have is dated. They are bringing out, refreshes and updates, but not new products. And some of the technology is a little behind the curve now in that most Teslas are built on a 400-volt architecture and most of their rivals are on an 800-volt architecture. And then, frankly, they've got a public relations problem in that I don't know what you do about Musk. We look at the numbers and we find that Tesla sales peaked all the way back in February of 2023. Just no one quite knew that at the time. So it's quite possible that with a politically quiet CEO, they would still be facing a lot of this, but they don't have that.
Sean, all of these things considered, in 2024, the Tesla Model Y was the #4 best-selling vehicle, according to Kelley Blue Book data. So as we're here in 2025, what are some of the early figures showing us about these roadblocks that Tesla's running into?
Unfortunately, our first quarter results will be coming out on Wednesday, so some of that I can't share yet. But I do think that you're going to see a drop in the Model Y. And as I said, the big issue they're facing right now is that both the consumer loyalty is going down, the consideration, the cross-shopping rate we're seeing go down, and the defection rate and people trading in a Tesla on something else is going up. So all of the trends are bad.
And talk to me more broadly about what you are anticipating when it comes to autos. Obviously, a sector that is keenly positioned to be negatively impacted by tariffs. We have news today that tariffs will not be implemented as severely on a sectoral basis as once thought. To what extent do you think that the rally we're seeing in some of these individual automaker stocks like General Motors, like Stellantis here, will hold given this potentially short-term news about tariff relief?
It's hard to know because that news is so short term. The tariff story changes regularly, and we're not just looking at that set that was changed today. There are also a round of car-specific tariffs that could come in on April 2nd. There's the threat of reciprocal tariffs. There's the effect of the steel tariffs, and it's changing day by day. Fourth quarter sales were quite strong, and that was fed really by two things. We had falling interest rates, and we had high inventories that dealers were looking to get rid of. Now, both of those things have changed in that the interest rate is no longer falling. And dealers I don't know that you're ever going to find a dealer who says, I don't want to sell all the cars on my lot today, but they are starting to look at their high inventories as a way to ride out the trade negotiations.
Sean, I'm going to be sitting on the end of my ergonomic chair waiting for that data to drop next week. Really appreciate the time.
Thank you so much.
We've got all your markets action straight ahead. Stay tuned. You're watching The Morning Brief. A high-profile copper bull is predicting new price records as President Trump's tariff plans infuse volatility and uncertainty into the stock market. Costas Bintas sees copper surging as much as a third from current levels, according to Bloomberg. Bintas, currently working at energy trader Mercuria Energy Group, was one of the first to predict copper would enter a multi-year bull market in the aftermath of the COVID-19 pandemic, and that demand for electrification would outpace supply growth.
Despite the optimism, copper prices have gone up and down over the past few years, notably surging to a record high above $11,000 a ton last year, only to stall out as Chinese buyers step back from the market. Now, President Trump's threat of 25% tariffs on copper imports is changing the game again. Domestic prices soaring compared to the rest of the world, creating incentives to ship more tons to the U.S. Mercuria estimating about 500,000 tons of copper heading to the U.S. versus the normal monthly import of just 70,000 tons. This is big for Chinese buyers, who account for more than half of global demand. China will be forced to compete with the U.S. under this dynamic. You can see copper futures here currently higher on the day. So got to check in on your broader market before we head to break here. Looking at stocks continuing their gains, you've got your S&P 500 up about 1.5%. And also you've got your S&P 500 moving past what we saw the market being at on election day finally here. And you've also got your tech-heavy NASDAQ up nearly 2%. That does it for Morning Brief. Keep it here for more analysis next.